Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of mastering chart patterns, head and shoulders, double tops, and more explained. Chart patterns are like road signs for traders, offering clues about where the market might head next. By recognizing formations like the head and shoulders or double tops, traders can gain an edge in predicting price movements. These patterns, rooted in human behavior, are central to technical analysis and help simplify the often chaotic market. If you're ready to spot trends and make more informed decisions, understanding chart patterns is a must. What are chart patterns? Chart patterns are visual formations on price charts that traders interpret to forecast market direction. These patterns emerge from the natural ebb and flow of price action, influenced by buying and selling activity. Think of them as blueprints, reflecting shifts in market sentiment. Getting familiar with these patterns is essential for technical analysis, offering insights into potential price trends and key decision points. Types of chart patterns. Chart patterns generally fall into two main groups: continuation patterns and reversal patterns. Each category serves a unique purpose in helping traders understand market behavior. Continuation patterns. These patterns signal that the current trend is likely to continue after a brief pause. They give traders confidence that the market's momentum hasn't shifted. Common examples include flags and pennants, compact formations that indicate a short consolidation phase before the trend resumes. Triangles. Like ascending or descending triangles, they suggest a breakout in the trend's direction. Reversal patterns. Reversal patterns mark a potential change in direction, signaling the end of an ongoing trend. Recognizing these is like spotting an early warning of a market shift. Popular examples include head and shoulders, often seen as a bearish signal, pointing to a possible trend reversal. Double tops and bottoms, indicating that prices struggle to break beyond certain levels, leading to a reversal. Understanding these categories helps traders anticipate the market's next move, whether it's continuing along the same trajectory or pivoting in a new direction. Why chart patterns matter in trading. Chart patterns play a vital role in how traders make decisions. They're not just a way to guess the market, they're tools for making informed moves. Here's why they matter. Predicting price movements. Patterns act as visual cues that reveal what the market might do next. For example, a triangle could hint at an imminent breakout, while a head and shoulders might warn of a coming decline. Managing risks. Trading comes with uncertainty, but chart patterns can help reduce it. By analyzing formations, traders set stop-loss levels to protect against unexpected shifts. Uncovering opportunities. Spotting patterns early gives traders the chance to act before the market fully reacts. Think of it like catching a wave before it crests. Timing is everything. In short, chart patterns are like tools in a carpenter's toolbox. Each one has a specific job, and knowing how to use them can make all the difference in building a strong trading strategy. Head and shoulders pattern. The head and shoulders pattern is a standout among reversal patterns in technical analysis. This formation resembles its namesake, two smaller peaks, the shoulders, flanking a larger peak, the head. Much like its visual namesake in real life, it marks a top or bottom in a trend, signaling a potential shift in direction. Traders often rely on this pattern to anticipate turning points in the market and adjust their strategies accordingly. Below, we'll break this pattern down and show how it's used for both bearish and bullish scenarios. Structure and formation. At its core, the head and shoulders pattern consists of three key parts and a neckline. Left shoulder. The first peak denotes a temporary high before the price pulls back. This forms the initial shoulder. Head. The price rebounds strongly, creating a higher high compared to the left shoulder. This peak forms the head and represents the highest point in the structure. Right shoulder. After the head, the price retreats once again, only to rise once more and form a second, lower peak. This is the right shoulder, and it's typically similar in height to the left shoulder. Neckline. The neckline connects the low points between the left shoulder, the head, and the right shoulder. This line acts as a support level in a standard head and shoulders pattern and becomes a crucial trigger point for potential sell signals. When the price breaks through the neckline after the formation of the right shoulder, it often confirms the completion of the pattern. A similar logic applies to the inverse version of this pattern, with the neckline acting as resistance instead. Bullish versus bearish head and shoulders. While the standard head and shoulders pattern is primarily bearish, its inverse counterpart signals possible bullish trends. Let's break it down. Bearish head and shoulders, standard. This version occurs after an uptrend, signaling that the market is losing momentum and could reverse downward. As traders, imagine this as a roller coaster that climbs steadily only to show signs of slowing during the final stretch. The neckline in this case is a level of support, and when broken, it typically triggers a sharp price drop. Bullish head and shoulders, inverse. This works similarly but in reverse. The inverse pattern pops up during a downtrend and hints at a potential upward reversal. Think of it as digging deeper into a valley before climbing out. Here, the neckline represents resistance, and its breakout may indicate a continued upward move. Understanding whether the pattern signals bearish or bullish momentum is key when planning your entries and exits. How to trade using head and shoulders. Trading the head and shoulders pattern requires a clear understanding of the breakout level, the neckline, and timely action. Here's how traders commonly approach it. Confirm the pattern. Ensure all three parts, left shoulder, head, and right shoulder, are visible and the neckline is clearly defined. Avoid acting too early based on incomplete data. Set entry points. For standard bearish patterns, enter a short position once the price breaks below the neckline. For bullish inverse patterns, go long when the price breaks above the neckline. Define stop-loss levels. To manage risk, set stop losses slightly above the right shoulder, for bearish trades, or below it, for bullish trades. This helps protect your account from unpredictable reversals. Establish a price target. Measure the distance between the head and neckline, then project it downward, bearish, or upward, bullish, to estimate a target price. This simple calculation often helps traders gauge potential profit levels. Here's an example to simplify. If the distance between the head and the neckline is $10, expect the breakout move to potentially cover that range, $10 either up or down, depending on the pattern type. While the head and shoulders pattern is one of the more reliable indicators, it's essential to pair it with other tools like volume analysis or trend confirmation to improve accuracy. It's not foolproof, but with a disciplined approach, it can serve as a powerful addition to your technical trading arsenal. Double tops and double bottoms. Double tops and double bottoms are two of the most reliable chart patterns for identifying potential trend reversals in trading. These patterns can give traders a clear picture of market momentum and provide actionable insights for entering or exiting trades. If you've been looking for simple yet effective tools to predict price shifts, these could be among your best allies. Recognizing the double top. The double top is a bearish reversal pattern that signals the end of an uptrend. It looks exactly like it sounds. Two peaks forming at roughly the same price level, resembling the shape of an M on a chart. Here's how it works. Formation. The first peak occurs when a rising price hits resistance and pulls back slightly. The price rebounds after the pullback, attempting to climb higher, but gets rejected again near the same resistance level, forming the second peak. After the second peak, the price typically breaks through the support level created during the pullback, completing the pattern. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.